everyone, welcome. This is NDTV Profit and I'm Alex Matthew. At the onset, let me wish all of you a very happy Diwali from all of us here at the NDTV network. May the light shine bright in all of your homes and may it bring a year of prosperity. This is a special edition of the Mutual Fund Show. Of course, it allows me to share this occasion with you, but it also gives us the opportunity to look back at a year gone by and celebrate how far we've come. And what a momentous occasion this is. We've got a fantastic panel. Joining me this year is Nilesh Kotak of Kotak Mutual Fund, Swaroop Mohanty of Mirai Asset Mutual Fund, and Ashish Somaya of White Oak Mutual Fund. Thank you so much, gentlemen, for taking the time, and wish you and your families and your teams a very, very happy Diwali.
Thank you.
At the onset. So, but what according to you has stood out in terms of what is the most captivating moment of Samvat 2080? Was it the AUM? Was it the 60+% growth in equity AUM? Was it the SIP number?
So, Alex, first let me wish all the viewers of NDTV Profit a very happy Diwali. I think the most important thing which stood us out for mutual fund industry was the trust and confidence of investors. Now we are no longer urban India phenomena. We are there in rural as well as semi-urban India. We are no longer rich people phenomena or upper middle class phenomena. We are now as much poor and lower middle class phenomena. And the most important thing is the trust and confidence. There was a time when market used to go down and we had to communicate with our distributors, our investors, don't worry, long-term growth story is fine. Now it is the opposite way. When market goes down, they call us saying that we are sending money, stay invested, we believe long-term growth story is good. So bas ye jo transition hua, that is the most satisfying thing.
Okay, so that's and it's a point well made. Swaroop, you want to add to that?
No, I think the two factors that you're mentioning, AUM and SIP, is a factor of investors coming in. And before COVID, we had some 2.3 crore folios unique. And now per year, we are adding 70 to 80 lakhs. I think that's the biggest satisfaction that one gets. Finally, it's a business of investors. And the other factor which is changing is 63% of our AUM is handled now by individual investors. So as a product, it is now beginning to reach the rightful owner, is my perception. And I dare say this is just the beginning. So the trust of a 30-year track record of the industry is now beginning to play out. The fund management has shown what they're capable of, and that will start catapulting into a different trajectory, is my opinion, about years to come now. That base has been now established.
Ashish, it's tough to be the third person to give me something new, but then I will still ask the question. What stood out to you?
No, I think it's the resilience. I think it's the resilience of markets, resilience of investors. And at the same time, if you see, like typically speaking, it's been discussed a lot. But if you see all the macro events, right, there's a lot that happened that could have scared people, right? FI selling, that's been discussed a lot, right? But still the resilience of the market is riding on what Nilesh bhai said, which is the confidence that investors have. The second thing I'll tell you that, I have some experience of building new brand and new AMC, and I'll tell you one more thing which has changed, which is encouraging for people like us, which is that the market has become a lot more meritocratic, a lot more respectful of performance, competencies and credentials. Look, we all started 25, 30 years back. Back then people didn't know the category at all. So ultimately they signed up for a brand with the belief that if there's a brand, they will deliver performance. But I think in the last 4-5 years, what has changed significantly is that people have started thinking that if you perform, your brand will get built. So, I think because the product category, the understanding of the category has gone so much deeper that how people look at brands, how people look at performance, I think that has changed quite a bit.
Lazy money, if you can call it that, people, or inertia, if you can call it that, Nilesh bhai, because people keep money invested, of course, for the long term, and that's great. But they do look at the scorecard, and it's very easy for people to switch right now, right? The applications just allowed you to place an order and you switch.
So India is a market where whatever you say, opposite is also true. There are smart people who invest for long term. There are smart people who understand that they are not smart and hence they choose right mutual fund distributor or advisor for hand holding. And then there are some people who will look at what is the next best performing idea and they'll jump. But the point which you made on lazy money, that is the most appropriate one. Between FY21 and FY23, markets have done extremely well. And the total investment by Indian households, you, me, everyone included, was about 4 lakh crore in mutual fund as per RBI data. About 9 lakh crore went into currency notes, which is like holding ice on a hot summer afternoon and hoping that it will not melt. That is the lazy money. That money is generating negative real return. That money is generating no return compared to inflation, and hence it's negative. And yet people put money in currency notes. That is the lazy money which we have to move to active money, which is mutual fund.
Speaking of money sitting on the sidelines, there is a significant amount of it, right? We've seen in IPOs over the past few months, some getting oversubscribed to the extent of, and would suggest that money to the extent of 2.5–3 lakh crore is sitting waiting to be invested, locked for a couple of days, 3 days, 4 days. What does that tell you about the capability? Either of you can take this, about the capability that Nilesh Bhai just spoke of deployment. We're still sitting at what, 5 crore unique investors for the mutual fund industry. It can be significantly higher.
Yeah. So, look, I think there is money chasing IPOs from, I think I look at it from two perspectives. One is, of course, nobody wants to get rich over a 30-year compounded period. Everybody wants to get rich. So everybody wants to get rich next week, probably. I think that is one perspective to the whole IPO craze. But the second perspective, I think, is that we need these big IPOs. Look, because the point is that ultimately the demand has to be matched by supply, right? I mean, it's great that there are big IPOs which are coming and getting listed in Indian markets. I think that is a salute to the fact that there is an investor base out there. You can always keep debating when an IPO comes, what is the valuation, what it should be. Ultimately, there is a supply-demand match, and that's where the price will get set. But I think in the long run, IPOs, we are not in 1990s. In 1990s, IPOs was a different thing. Today, when IPOs come, they are coming after companies spending 12 to 15 years in the private equity cradle.
There's a track record.
Right, there is a track record. Last few years, you look at it, the quality of IPOs has been fantastic. You see diagnostics, you see hospitals, you see some of the new age businesses, you see some of the capital market companies, you see our industry. I think they have made great wealth for, the chemicals and pharmaceuticals. They have made great wealth for investors. I mean, if we don't want IPOs, what do we want? We want these great businesses to be with private equity?
No, you must have. And you must have issuances
want?
because of the kind of liquidity that is getting pumped into the system. You need something to suck that out. But the other aspect that both of you all spoke of is the tendency to want to get rich quick. And we saw that as well, Swaroop, over the last year. And of course, a show like this is an opportunity, as I said, to look back. And this is one aspect that we have to look back at. The regulator themselves coming out and saying, look, hold your horses, be a little careful. 9 out of 10 traders, individual traders losing money. But that's visible even in the mutual fund industry, where everybody jumping onto a sectoral or thematic bet, right? That's the largest category. Swaroop, what does that tell you?
Alex, somewhere all of us have gone through that process. When we started, we were also brash return chasers. So we are seeing an economy now unfolding on the demography in the form of investors. So when they start, they believe that this is a business of return chasing. But as they grow, they will realize that this is a business of risk mitigation. That process all of us have gone through. I, as an investor, used to be an investor on tips, sitting out of Calcutta, listening to that next tip from Mumbai. But you grow as an investor. Probably we are in the cusp of that. But I believe the young are smarter than we were. They will graduate very quickly, right? That's bound to happen. And then it's a matter of time that it will happen. I mean, for us, if we hold our ship steady, and then continue the track record, sooner or later what Nilesh Bhai is saying will happen to us. And that's a reality. Now look at, as an offset to what Ashish just laid out, all these new age businesses are no longer large cap businesses. So a lot of wealth will now be created in the mid and small because there is no mutual fund which is a large cap. There is hardly a hospital which is a large cap. Portfolios are changing and portfolios are getting dynamic. So some of our older theories of investing will also change as the economy unfolds. It's a brilliant time to be an investor, right? You are seeing new companies coming up, you've seen new investors coming up, you have new AMCs coming up to manage your money, you have new categories unfolding. So the choice for an investor is changing. Hence, some of the approaches which I had when I was 25 will not hold good for somebody who's 25 now, is my submission. So I will not jump into any conclusion of this is right or wrong. Let time takes its toll. But finally, an investor who mitigates the risk and makes a portfolio closer to his or her risk profile will have a good investment journey is the reality of this business.
Fair point. Okay, but having said that, Nilesh bhai, I want your opinion on this. We're talking about the largest category in terms of assets under management and in terms of products being offered. Sure, number of schemes in the thematic and sectoral fund. Ultimately, the mutual fund industry has provided what people have asked for, which is themes. But some of these are very narrow sectoral bets, and unfortunately, in a down cycle, these tend to get hit very badly. Is that a recipe for disaster? We've seen an amazing bull run, but is this a point where you say, hey, be a little careful?
So Alex, we haven't forgotten our lessons of 2000 TMT bubble. In those days, a lot of money came into TMT sector. And then eventually it did leave a very, very bad taste in the mouth of investors. If you look at any thematic fund, sectoral fund today, there's a very, very unambiguous communication from all of us that you have to invest for long term. Don't invest if you have short term horizon. Be ready for volatility. And most importantly, moderate your return expectations. What you got in last 5 years, you are unlikely to get in next 5 years. Undoubtedly, we'll have to keep on reinforcing this communication. But as long as I'm getting long-term money, ready to take little bit of volatility with moderate return expectation, every theme, every sector will make money for investors.
Okay.
Now, only one,
you want to
one needs to differentiate between a sector and a theme.
Yes.
Right, that's not coming out very large. People are confusing sector investing as thematic investing.
You want to elucidate that with an example?
I mean, say, just give you the broad 4 or 5 themes of the economy. Say, consumption is a secular 13-14 year.
Manufacturing.
And it's getting re-rated now. Manufacturing is just about getting started. And you look at next 15 years, probably manufacturing will be something which you're catching out early. 37% of our index is banking and financial. And when I started my career, Nilesh bhai, correct me if I'm wrong, it used to be banks. Then it became bank, NBFC. Now it's bank, NBFC financials. Now it's bank, NBFC financials, fintech. So the point I'm making is, yes, the themes will grow. Don't confuse sector for themes. And if you catch a large, broad theme, and somewhere, you know, those balance sheets of that theme can be very, very structurally strong also. That's the only submission that I have.
Healthcare versus pharma.
Yeah, healthcare versus pharma, absolutely.
So taking your own example, you know, you said narrow sector. I mean, investing in a transportation fund is not the same as investing in, say, a manufacturing fund or a digital or a, you know, healthcare. You know, it's not the same. I mean, like for me, there are 2 or 3 rules for investing in thematic funds. One is, like has already been discussed, it should be a broad theme with some underlying macro tailwinds or some sustainability to it. That's one. So sufficiently broad. Second, generally it is better to do it when it is counter-cyclical. See, I'll give you an example. Today, people have been investing in, say, a defense fund. Example, when the defense funds came in, the 5-year CAGR of defense index was 60% compounded before the funds came. Not all of them, some of them. Then I'll give you another example. So second is be counter-cyclical. And third is related to your point, which is that you should invest in a theme which is likely to become or at least likely to remain a significant part of the broad market, like what Swaroop said. You know, you invest in something which is 1% of entire market cap and not likely to become even say 10, for example. Let's say the whole IT is 11-12% of benchmark.
Sure.
If you add digital underlyings, it might be say about 19-20% of benchmark, right? So you have to look at something which is material in the overall frame of the economy. If you invest in something which is half or 1% of the market cap itself, it's very narrow. The cyclicality will be so long. If you get in at the top, you will not get back for the next 10 years.
At the start of a new Samvat, and of course we are looking at it and saying that you're not investing for this Samvat, you're investing at this juncture for the next 10 years or 5 years at least. In your opinion, what would those counter-cyclical themes be?
So Obviously, management plays an important role. In our sector or in a theme, you can get good management, you can get crook management. So there's no point in diluting the impact of management.
Sure.
But within that, if you look at sector, today market is probably going to outperform in quality over momentum. High floating stock, diversified ownership over concentrated ownership, and reasonable valuation over expensive valuation. Now, keeping these three parameters, it is fair to say that sectors like IT, pharma, consumer staple, FMCG, telecom, auto, cement, they provide more options to invest which will outperform the market on a risk-adjusted basis. There are sectors like defense, railway, capital goods and infrastructure, consumer durables, where we believe valuations are ahead of fundamentals. So go for quality over momentum, high floating stock over concentrated ownership, and reasonable valuations over expensive valuations to build your portfolio. And most importantly, while you're looking at this Samvat, don't look to invest on a 1-year basis, invest over 5-year, 10-year basis with moderated return expectations.
No doubt. I want to take one of the points that Nilesh mentioned, and either of you can take this, is that perhaps it's a good opportunity to move from momentum to quality. It's been one of the themes of not just the last year, but this entire bull run from the low point at 2.5 years, right? And the strategies that have outperformed have largely been momentum strategies. Invariably, that turn happens, and my question to you is, are we on the cusp of that turn? From quality to, momentum to quality, quality to momentum.
So I would say that, Alex, if you really ask me, it's already started happening.
Yeah.
See, if you stack up all sectoral indices or all style indices, you stack them up, you will find what is the best performer in the last 3 years is the bottom performer in the last 3 months.
Yeah.
So for instance, in the last 3 months, even in the last 6 months, Nifty quality has outperformed Nifty value, for instance. If you see in the last 3 months, the best performing sector is IT, pharma, consumer. It's no longer infrastructure, PSU bank, defense, energy, none of those. So market is perpetually in a relative valuation, mean reverting kind of mode. It's already started happening, if you ask me.
Okay. So fantastic.
Already made the turn. Yeah.
All right. You want to make a point?
I think there are two parts to a portfolio creation. One is every fund manager will tell you buy a good business as a good price. Now, the entire market is talking about a price not being good on the second half of what Nilesh Bhai said. Now, I'm not a big proponent of selling something and buying something. That is timing the market. Just by virtue of seeing the mutual fund allocations. Now, past allocations have been to the bottom half of what Nilesh Bhai said. The fresh allocations have to counter that.
Incremental.
I don't know whether this will last or not. As a fund house, we've not agreed with the valuations of the market. We've been sitting outside it for 2 years, right? So I don't know whether we are right or the market is right. There's no point predicting that. What you can predict is your asset allocation. And that, the more you think of the market, the less money you make. The more you think of asset allocation, the more money you make. The choice is yours. The fresh allocation has to go into places where the market has not run, as simple as that. And if you just look at both the sides of Nilesh Bhai's answer, the first half is where the fresh money should go.
Okay. Incidentally, one of the statements that I live by is that the wisdom of retrospect is flawless. And you can always look back and say that you could have done something better.
Yeah.
It's the case, and I think in this industry it's more relevant than in certain other cases, right? There have been a lot of statements being made and discussions in the public about mutual fund managers holding cash and keeping it on the sidelines, right? Some people have asked, why do you not deploy it? Ultimately, I'm giving you funds to deploy and to invest. But if the mutual fund manager has felt that this is not fitting my my book of valuations, they have chosen to sit on the sidelines. What is your opinion on that?
So as long as you disclose to the customer what your strategy is, I think both sides have equal points.
Merit. Yeah.
We believe that we are not going to take cash call
Yeah.
because my partner, my mutual fund distributor, my advisor They are taking asset allocation call. Now, if Alex advisor has told him to put 50% in equity, and I take another 20% cash call, you come down to 40%, not 50%, then your asset allocation goes for a toss. But at the same time, if there is a fund manager which has taken a cash call and he has communicated it, then you know how to price that into your asset allocation. More importantly, for a common man, there are products like asset allocation fund, balance advantage fund, and equity saving scheme, where we are taking allocation call between debt, equity, and in some funds, precious metal. So you take a call based on the disclosure and philosophy of the fund house. Both will sound appropriate at different point of time. In a rising market, not taking cash call will work for you. In a falling market, taking cash call will work for you.
Exactly. So you want to add to that?
No, we are a fully invested fund by mandate. We believe, like Nilesh say, asset allocation happens at the distributor advisor's end or at the investor's end. You're giving us money to buy an asset class, we will buy the asset class. And I think at any points of time, there are 60, 70 good stocks to buy. Now, taking a cash call, like Nilesh say, each to his own, but is timing the market. If you look at the two instances, one is 2008, post that, people who went into the cash were actually the laggards. Post-COVID, since it didn't give us a chance, all of us were invested. The entire industry caught the enter of the market. I mean, catching it on the cash side, we believe is not our forte. So better be fully invested.
Ashish?
Yeah, so you should not second guess. I'm more with Nilesh Bhai's rationale, which is that if somebody has, let's not assume that people are dumb.
No, of course.
If they want to buy a balance advantage fund, they could have bought a balance advantage fund.
Yeah.
Now, I am an equity manager. You land up on my table, I am supposed to deploy money in equity. So what we believe is that market is always fairly valued. If you want to beat the market, you need to have a relatively better portfolio compared to what the market is showing. So I'll tell you, it's a joke, lighter note, okay? No disrespect to anybody, but just a joke. Tell me, what is the best way to defeat Mr. Vishwanathan Anand?
Be a grandmaster yourself.
No, you don't play chess with him.
Okay. Yeah, if you can't beat, I mean,
you challenge
in this
him
case,
to,
you can't join him.
Yeah, you challenge him to table tennis or something.
Yeah.
Right? So you agree that's not the way to defeat him? So the way to defeat the market is not by going out of the market.
I assume you were talking
the market
about playing chess.
No, so now talk about the market. If I want to, an equity manager is supposed to beat the market by being in equity.
Yeah.
And doing a relative job. An equity manager is not supposed to beat the equity market by saying, I choose not to be in equity.
That's a fair point.
So it's not something, so you're supposed to beat the market by having superior stock selection on a relative basis. Yeah. That's how you beat the benchmark. You don't take asset allocation calls. That's the key part.
Speaking of asset allocation calls, one of the major changes that has occurred over the last year has been the change in the tax treatment of all asset classes, right? So you have, suddenly you have multi-asset, which becomes so much more interesting than it has been in the past. Do you think that this is going to have long-term implications for the flow of money? Will more people have moved into hybrid, and I think some of the communications that have gone out have been beneficial. Multi-asset, is it something you like?
So Alex, I think we are selling our product on how they are suitable for customer, not how they are tax advantageous.
Yeah.
Compared to all the other similar financial services, mutual funds don't get any special tax benefit or treatment. And whatever we get is also not permanent. It gets revised with retrospective effect.
Yeah.
So my recommendation to investors,
ignore it.
And as an industry, all of us have pushed, please don't focus on tax part because you never know when it will change. Please focus on whether this product is suitable to you or not.
Okay, then let's talk about the...
No, but Alex, see, you asked a question on what was realization last year.
Right.
The realization on the merits of multi-asset is big for me.
It is.
Because guys like me have stood up of enough stages and said equity is the growth asset class on a 10-year horizon. You now debating with gold, right?
Yeah.
The next 2-3 years, it's going to probably remain that way. So the multi-asset on the merit of the product finds place in many portfolios now. Forget taxation.
That's exactly what I was going to ask. Ashish, you want to weigh in on this because you're talking about, even if you're talking about 10% allocation to gold, which most of these multi-asset funds have, it's on a commodity that has gained 30+%, 37% over the last 1 year, and it has significant merit.
Yeah, so our belief is that if you see what is the purpose of having gold in the multi-asset portfolio, the purpose is that it should counterbalance the volatility of equity. So in fact, we've been propagating even higher allocation. Like our multi-asset fund on an average is say 23, 24, 25% in gold, right? So yeah, I mean, it's worked very well. The other thing is, you know what, fixed income. If you see fixed income, there's a dearth of choices because yields are low. And then, you know, yes, there is a preoccupation with taxation. So fixed income, there's a dearth of choices.
Yeah.
So the way we construct multi-asset is to create a viable alternative for pure fixed income.
Okay.
So even more conservative. So we have higher gold. And I think that a lot of people make one mistake, which is that they think that they should have gold because there is a view on gold, right? That is one thing, but you don't need to necessarily have a view on gold. In a multi-asset portfolio, you're not supposed to have view on any asset class. You're just supposed to have a portfolio which will follow some valuations of relative norms and keep rebalancing across asset classes. And the asset allocation should be unfettered, meaning each asset class should be allowed to go where it deserves to go based on relative value.
Yeah.
Right? People make the mistake of investing in multi-asset funds with a view on gold.
Yeah. Which is not the purpose of the fund.
That's not the point.
You buy a gold ETF if you want to do that.
Yeah. So we are not taking a view on gold. We are just ensuring that there is an asset allocation which is unfettered and the portfolio keeps rebalancing depending on what our model suggests.
So one advice, Alex, for all the viewers of NDTV Profit. In our culture, in our tradition, we go and buy gold on Diwali Day, Dhanteras Day. A lot of people buy gold in small denomination, 1 gram, 5 gram, 10 gram. The transaction cost they incur for buying gold in smaller denomination is huge. They don't realize it. I think it is time where we upgrade ourselves. We maintain tradition, we follow culture, but we improve it by going into buying gold ETFs where transaction cost is less than 0.5% or 1%. Compared to buying physical gold, buying gold ETF will actually give you substantially higher return.
No doubt.
Nilesh bhai, if you go around Mumbai, the Gold Council is advocating buying gold ETFs for the first time instead of buying physical gold, right? This transition is happening.
Absolutely, no doubt. One last very quick question before we move into a small rapid fire round that I've set aside, and I've actually sourced questions from the newsroom. Let's see how you all answer. Is artificial intelligence the buzzword now globally? But are there applications for the mutual fund industry? Of course, it's been pointed out by the gentleman right here that you need to draw a distinction between machine learning and or quantitative indicators and artificial intelligence. But do you think that there are applications?
Undoubtedly, Alex. 5 years down the line, you'll be talking to a computer over here and not Nilesh Shah. People who will not leverage AI, they'll be left out. People who leverage AI, they will do well.
And how do you leverage AI at this juncture?
First, you have to accept that AI is important. Start from basics. Second, at my age, for me to master technology is very difficult. I'll have to give the leadership to younger people who know for whom technology will come on its own. Third, we'll have to push entire organization that AI doesn't mean just adopting what we think is appropriate. We'll have to compete with the best in the world because there's someone sitting somewhere. And we have seen that in trading. In trading, why 9 out of 10 people are losing money? Because that 1% is using data, connectivity, and algo to outperform you. What's happening on trading is going to happen on investment unless until we leverage ourselves with AI.
Okay, you want to add to that, Jem?
Yeah, we did hire our head of AI last year.
Okay.
So that's been a learning apart from my son being an AI developer. So
wow.
I hear it day in, day out at home too. But what Nilesh bhai is saying is correct. See, there is algo, and don't confuse algo with AI. AI is predictive. AI gives you data, and data is never wrong. Once that data starts getting a little bit of consensus, you then form your human brain to adapt that quickly. First is to accept the fact that it will give you data. Right? And then more it starts learning, it will start giving you more data out of the whole thing. We were just discussing that, you know, we have Global XR, global ETF provider. Its social media fund was launched before Facebook was there, not IPO, Facebook. We're talking about a lithium fund which is 10 years old. That's what AI can give you. And then if it becomes more and more rule-based, more and more data-based, the ability to make informed decisions only enhance. Now, somebody who feels AI will kill you, AI will kill you. but somebody who thinks can use it as a great, powerful data to back decisions will probably prevail in the world.
All right. I know what you think about it, more or less gels them. So I'm going to jump into the rapid fire segment straight away. And I'm going to try and give everyone an equal opportunity. Ashish, you won't always be the third person to answer, okay? First question, big family function or vacation? Diwali?
Big family function.
Any day.
What?
Big family.
Big family.
Family function, we already have it.
It's
planned.
all about family.
And family is not only your relatives, but also your office, because you spend more time with them.
Absolutely. I should say that for my viewers because I spend most of my time with them. Favorite mithai? Swaroop?
Laddu.
Ashish?
Some chocolate stuff.
Chocolate stuff.
Something to do with chocolate.
Nilesh bhai?
Gujju bhai, mithai, everything.
Okay, speaking of Gujju bhai, jalebi fafda, choda fadi or mathia?
Jalebi fafda.
What about you?
No, we have we have our Odia thing, which is called Chena Poda. I was in Bhubaneswar yesterday, so it's at home. It's a fresh chena baked, so that's our favorite.
Ashish?
Jalebi.
Jalebi fafda, okay. I'll start with you. Fataka or quiet Diwali?
Pataka.
Any day, it's one day. Somebody tweeted that some country is bombing something for over 2 years and no damage to climate is happening. We just do it for one day and so much damage happens. I am on this side.
Okay, Fataka.
Fataka,
you're saying?
Fataka.
Okay.
I have graduated to quiet Diwali.
Okay, all right. So, and the last question that I will ask, we've all talked about where we think that the industry is going to go. Professional goals for Samvat 2081. What are you most looking forward to? Ashish, this time I'm starting with you.
So our fund just, we're a new firm, right? We're not even 1% of the industry's equity AUM, but we just crossed 1% of the investor base.
Wow.
So we have 6 lakh unique clients.
Congratulations.
So my goal is to cross 1 million.
Okay. Very good. Okay. Swaroop?
For us, everything is an outcome of what you do. So retaining the fiduciary capacity for the rest of our business here will be priority number one. If that happens, the rest will all happen.
Follow. Okay, Nilesh?
Just continue the same thing. We are managing trust and confidence of our investors. Trust is built over decades and lost in 1 second.
Yes. So
just keep on doing the right thing.
We began with this message and we are ending with this message. Thank you so much, gentlemen, and wish you, your families and your teams a very, very happy Diwali from all of us here at the NDTV.
Happy Diwali.
Very happy Diwali.
And to you, dear viewer, thank you so much for tuning in to this special edition of the Mutual Fund Show, and thank you so much for sharing your Diwali with me. It's been an absolute pleasure bringing it to you. Do stay tuned. This is NDTV Profit.